The ability to be able to identify liquidity and an understanding of how to use it in your trading can be incredibly valuable. When you can spot where liquidity sits in the market, you can basically identify these magnet areas on which price is drawn towards. That means you can take high quality trades with clear targets, identify specific reversal points in the market, and most importantly, avoid a lot of losses that you might take if you didn't understand liquidity. And it doesn't matter how you trade. I don't care if you trade trend lines, support and resistance, order flow, ICT, this video will be incredibly beneficial for you. I'm going to run you through the 3 forms of liquidity that every single trader should know and break down what exactly is liquidity and how it moves the market. And by the end of this video, you'll understand how to use it at an extremely high level. So with that said, let's get into it. The first thing you need to understand is what actually is liquidity. And in simple terms, liquidity is orders or money resting in the market. Price moves because of the flow of these orders. So when there's more buying than selling, the market goes up. And when there's more selling than buying, it goes down. For any big move to happen, whether it's a strong push up or a big dump, price needs to tap into an area that has a large amount of orders waiting for it. So that's why markets move freely through the middle of ranges, because there's not much liquidity there. No one's really buying or selling in the middle of the range like you can see here. And if they are, it's just a small amount of volume. But when price comes out to take a swing high or clear a swing low, that's when you start seeing bigger reactions or reversals like this one here. Why? Because above swing highs or lows is where liquidity lives. That's where most traders have their stop losses or pending orders sitting. For example, anyone shorting from a high will have their stop losses just above it, and anyone buying from a low will have their stop losses just below it. You'll also have breakout traders placing buy stops above highs and sell stops below lows. So when price actually hits those levels, it's triggering a massive amount of orders, stop losses, take profits, and breakout entries all at once. And that injection of volume is what drives those sharp reactions on reversals that we see. So in short, liquidity is simply a cluster of orders sitting above highs and below lows, and all around obvious levels that price seeks to react from. And that is exactly why you often feel like you're getting stopped out right before the move goes your way. You're not spotting the liquidity sitting right where you're entering. Now, as I said prior, there are 3 types of liquidity that you need to be able to identify. I'm going to show you how to do that without any confusion so that you can start using them to your advantage. And those 3 are equal high and low liquidity, trendline liquidity, and range liquidity. And each one of these forms a crucial role in how the markets actually move. So once you understand how these 3 forms of liquidity interact, you'll start to see why price moves the way it does instead of just reacting to it after the fact. When it comes to identifying liquidity in the market, your main goal is very simple. Figure out where the majority of orders are sitting in the market. Because at the end of the day, markets move because of those orders, not indicators, not luck, but the actual flow of those buy and sell orders being triggered. Now, let's start with equal highs and lows. We're basically talking about classic support and resistance levels. Equal highs form classic resistance zones, an area where multiple highs lined up. Equal lows form a classic support zone, an area where multiple lows lined up. Those levels look clean, right? They're obvious, and that's exactly why everyone trades from them. Old traditional trading education still teaches traders to sell resistance and buy support. So then what happens, right? When traders sell from resistance, they place their stop losses above the highs. And when they buy from support, they place all their stop losses below these lows. That instantly creates pools of liquidity sitting on both sides of the range, above equal highs and below equal lows. But that's not the only liquidity sitting there. You've also got all of the breakout traders with buy stops above highs and sell stops below lows waiting to get triggered if price breaks out of here to then continue the trend. So what you've actually got at these levels is you've got stacks of orders, stop losses, and pending orders all clustered around the same levels. That is liquidity. So because there is so much liquidity above these equal highs and below these equal lows, this gives us 2 very powerful uses that we can do with them. So let's say you were to find a really good long position entry from down here, all right? These equal highs would make perfect sense as a target because price is naturally drawn to that pool of liquidity above it. And same as if you were in a short, you can do the exact same with equal lows. If you were to find a good setup, say from an area of supply around here, then you could use these equal lows as a good target because these areas are magnets for price. And using them as a take profit gives you that clean, high probability exit. But here's where it gets actually more interesting. using them to time your entries. Now, when you see equal highs forming, your first instinct might be to sell resistance. And my simple tip here is just don't. And the reason for that is because that's where most traders get trapped. Because the market will often push through those highs first, take out all the stops, grab the liquidity, and then reverse, your best option is to simply wait for the liquidity sweep and then look to position yourself. That way you will avoid losing and being trapped in the first place. That fake breakout, or what people call a stop hunt, isn't manipulation. It's just how the market clears orders so larger participants can position themselves. Think about it, all right? Every time a retail seller gets stopped out above resistance, they're forced to buy back into the market to close their short. That creates buy-side liquidity. And that's exactly what institutions and large traders need. Buyers they can sell into. They can't just drop 50 million into the market at once. They need the liquidity that comes from those stop losses being triggered. Retail traders, people like me and you, only make up a very small portion of the total volume in the market. The majority of trading activity comes from large institutions, managing tens or even hundreds of millions at a singular time. For every seller, there must be a buyer. And for every buyer, there must be a seller on the other side. That's how every transaction in the market actually works. So if these institutions want to enter with that kind of size, they can't just click buy or sell anywhere they want. If they did, they'd move the market instantly, right? Instead, they have to seek out liquidity. They need to push price into areas where there are enough opposing orders to fill their massive positions. And those areas are above equal highs and below equal lows. Once the liquidity is taken and those large orders are filled, that's when you'll usually see this strong reaction or reversal begin. So equal highs and lows are amazing to use for obviously targets, positioning yourself in the market, so actually knowing and timing when the move is going to happen, and most importantly, avoiding taking those silly losses where you end up having to re-enter after. But let's go ahead and jump over to the NQ chart, and I'll show you a recent example of where you could have used this. So here is, of course, the NQ chart. And I kind of wanted to look at this chart and think, what is the first thing that kind of jumps out to you? Because for me, it's this obvious level here, which is a level of resistance, or for us, better known as equal highs. All right. So based off the logic we've just gone through, this would be a significant liquidity pool. So what can we actually expect here to happen? All right. We can expect price to push up through this liquidity pool and then look to see that sharp reversal back to the downside. Okay. So let's take a look and see what happens. Now price does then push up through the liquidity pool, takes out the equal highs, and then these orders now get filled. So how can we actually use this to our benefit? Once we see some kind of confirmation that this is obviously this quick move up to the upside and it's kind of this fake move, then we can look to short this down to our next liquidity pool. Now you might be wondering, where's the next liquidity pool? Well, the next liquidity pool would be this obvious level of support down here, or in other words, equal lows. So this would be our opposing liquidity pool. So we're looking to trade from one liquidity pool to the other. So we could go down here, mark up our position, set our targets at the bottom of these equal lows or this liquidity pool, and then look to ride the short position down. So that is equal high and equal low liquidity. Now let's move on to trend liquidity. The concept here is the same as everything we've covered so far. Liquidity is simply an area where there is a high concentration of orders sitting in the market. And when it comes to trend lines, that's exactly what they create. A buildup of stop losses, buy stops, and sell stops sitting around them. Most retail traders are taught the classic trend line strategy, right? You all know how it goes. Wait for a retest of the trend line to sell, or wait for a break and retest to buy. The problem with that approach is that it assumes the trend line itself defends the trend. And that's just simply not true. If you actually break down price structure, the highs and the lows, you'll see that trend lines often have nothing to do with whether the market is actually bullish or bearish. So let's say we have a downward forming lower highs and lower lows here, right? Unless price breaks a previous high, so this previous high all the way here at the top, the trend hasn't actually changed. No matter how many times it breaks or retests this trend line, the trend until this high is actually broken is still in fact bearish. So a trend line break doesn't automatically mean a trend reversal, it just means price has broken a visual level, not actual structure. And until a previous high is taken out, the market is still in fact bearish. And everything that happens around that trend line before a real break of structure is just liquidity continuing to be built. Now, let's think again who's trading around this trend line. We have sellers short and get the trend line resistance with their stop losses above the line like this. Then we have breakout buyers waiting for breakout above the trend line with their buy stops ready to trigger, right? Then we have retest buyers, okay? People waiting for a break and then a pullback into the trend line like this to then buy with limit orders. All of these orders create stacked liquidity right above the trend line. And that's the key, because it means that even when price breaks above it, that doesn't necessarily mean that the trend has reversed. It just means price is tapped into that pool of orders sitting above it. So here's what's typically happens, and you'll see this over and over again once you start watching for it, right? So what happens here is price pushes above the trend line, triggering all of the breakout traders here, right? And this then hits the stops of the early sellers that were trading this retest of the trend line here. And then also fills all of the pending buy orders from all of the retest traders who are looking for price to trade above this trend line and then retest and continue the trend. All of that then creates a massive burst of liquidity. And as I said, right, with actual market structure, until we break this high, we are still in fact bearish. So what you could have done is marked out this supply area up here, right? And then looked to trade the continuation to the downside and actually use this trend line and all of these orders here as your liquidity. And as I say, once this move happens, that's when the market usually reverses right back down, stopping out both sides, the breakout buyers on this trend line and the retest sellers all in one move. So both groups end up losing and the institutions win, because they understand what the real game is, that this trend line isn't support, resistance, or supply and demand. It's simply just a liquidity trap. Now, I'm going to show you an example of a trade I took earlier this week and how I used trendline liquidity and equal low liquidity to my benefit. Now, this was the trade I was in here, right? And I was considering taking my position off at this low. But because I noticed here that this trendline liquidity was here, right? And what do we know about trendline liquidity? Is that below each one of these lows on the trend line, there is a significant amount of liquidity. So this entire area here is a liquidity pool. And then just below that, we also have this support, or should I say these equal lows, right? So then below this, we also have this liquidity pool. So in this entire area here, we know that it's a significant amount of liquidity. So instead of just taking my target here, I extended my target to the bottom of these equal lows or to this liquidity pool. And then I managed to catch a significantly higher R multiple trade. And you'll notice that once we take out this liquidity pool, price then starts to reverse back the other way. So now let's finally talk about the final form of liquidity, which is range liquidity. Range liquidity builds up inside consolidations, the sideways phases where the market is chopping between clear swing highs and swing lows. And if you study price long enough, you'll start to notice this pattern again and again. After the market forms a low, it often sweeps that low before making a meaningful reversal. The same thing then happens at that high. It takes out the high before then reversing lower. And then zooming in on any smaller range, you'll see the same sequence play out. Price then forms equal lows here, sweeps them, and then rallies. It keeps repeating this process, clearing both sides of the range until it's ready to commit to a proper trend, which then, after sweeping these lows, happens to happen. That's because throughout the entire process, liquidity is building above and below these obvious swing points, right? There's a larger range of liquidity sitting above the highest high and below the lowest low. And those are the area that the market is drawn to before making its next big move. So as you can see here, this extremely obvious wick was put in. If a wick seems to look, extremely obvious when you jump on the chart, it just sticks out to you, right? And you just can't help but notice it. There's a good chance that there's a significant amount of liquidity resting above that. So in this specific example, once we actually sweep out these lows down here, these equal lows, now that we can be pretty confident that the next range high is going to be this obvious wick where this liquidity pool is. So we can actually enter a trade after we sweep this low and mark out our long position and use this obvious wick here as the top of our range as our liquidity pool to use for a target, because we can be pretty confident that price is going to draw towards this. So why the market is constantly sweeping highs and lows inside ranges? It all comes back to transactions, as we said before. The market moves because orders are triggered. Buyers, sellers, stop losses, take profits, and pending orders are being filled, right? Buyers in the range will have their stops sitting under these swing lows here, and the sellers will have their stop losses sitting above these swing highs here, all right? Those stop losses are effectively pending orders waiting to be hit. So if you think about it, that's where the liquidity is going to exist. Meanwhile, in the middle of the range, in this area here, right, that's very little liquidity there, and there aren't that many stops, and there aren't that many large pending orders, which means there's no reason for price to react or reverse in that zone, right? That's why you rarely see the big reversals or impulsive moves like the one here happen in the middle of the range. They almost always happen after liquidity has been swept at one of the extreme points. The market's job is to move towards those areas of liquidity, clear them out, and then react once the larger orders have been executed. That's why you see so many highs and lows get taken right before major reversals. So there are two very powerful ways that you can use this to your advantage. If you're looking at a range that's messy and full of wicks like this one, and constantly just sweeping both sides, simply just don't trade it. When you can't make sense of a price action, it just looks like sweep after sweep after sweep, that's a strong sign that the market is still accumulating or building up liquidity. Stay out, because if you don't know, you'll likely end up being part of the liquidity that gets taken. Instead, what you can do is wait for the sweep here, actually let price take out the range high or low, and wait for a clear shift in structure or momentum. And once you see that reversal behavior, you can then position in the new direction, target the opposing side of the range. So in this scenario, the opposing side of the range also has this trendline liquidity built up, even furthering our bias towards the downside. It's the exact same logic as equal highs and lows. Liquidity first, structure shift second, entry third. So now you understand the three main forms of liquidity: equal highs and lows, trendline liquidity, and range liquidity. They all show up in slightly different ways, but the underlying concept is the same. The market moves to collect orders, not randomly. And if you can train your eye to actually spot these areas of liquidity in the market, you'll be able to understand what the market is actually trying to do and not reacting after it happens. The goal here isn't to guess the direction of the market, it's to actually understand the intent. And when you understand why price moves, trading starts to become a lot more logical, because you have a narrative behind everything that happens in the market. And if you want to see myself and all of the other traders at TradeZella break this kind of stuff down for you every single day live in the markets, then make sure to join our free Discord. The link is down below in the description, and I'll see you guys in the next one.